This is Right on the Money with Tom Mosley, founder of Mosley Wealth Management.
Our mission at Mosley Wealth Management is to help people make sure they never run out of income the rest of their life and they pay as little as they're legally required to pay in taxes.
Since 1995, Tom Mosley and his team have been creating comprehensive, custom financial plans to help you preserve what you've earned and pursue what you've envisioned.
In retirement, a lot of people have built a great lump sum. We call that your lumber yard. But you need a blueprint to put that lumber yard into a plan that you can build a retirement house to live in.
What's on your mind this week, Southern California? The stock market, taxes, inflation, income, Social Security, how to ease into the life of your dreams? Let's discover conservative financial strategies starting right now. This is your Right on the Money Radio Hour with Tom Mosley.
And a very happy weekend to you. You are listening to Right on the Money with Tom Mosley. He is the founder and president of Mosley Wealth Management based right here in Southern California. And I'm your host, Kristen Oakley. Each week, Tom and I are committed to providing retirement planning solutions for you. We're so glad you're joining us today. Tom, my friend, always good to be with you. And I know you have some exciting updates to share with our listeners this weekend.
I do. Great to be with you again, Kristen. Hey, I want to let all of you know that we're not adding a new office right now. We still have our 5 offices, but in our building at 9820 Willow Creek down in San Diego, that's right on the Carroll Canyon exit off the 15 freeway, we are expanding our office. We're going from about 700 square feet in a little office that we got started down there in about 2.5 years ago. We're moving up to the big time. We're moving on up, and we're moving up to the 4th floor from the 2nd floor. We're going to be in suite 440 up there. But what that means is we're going from 700 square feet to almost 3,000 square feet.
Wow.
We're down. We've got it expanded from one real conference room to 3 conference rooms. We're going to be able to house as many as 8 to 10 people down there as we continue to grow, and you continue to come to us and realize that we bring such value to people in the San Diego area. We're just excited about what we're doing down there. We added a new advisor down there January 1st. We're adding a new paraplanner down there right about this time in the middle of March. He's going to start working again, and we've got an investment advisor who's coming to us in the middle of the year. Wow, we just got so many things happening, so many things growing, and that's just one of our offices. We're also expanding in our Encino office as far as people, and then in the last half of the year, we hope to add a full-time office in West LA, close to the airport and El Segundo area, and then down in San Diego, in the northern San Diego area, somewhere Vista, San Marcos, Carlsbad. We're not exactly sure, but hey, just things are looking great. Our people are working well. We have a great culture with what we're doing. We are building a company that's going to be here 100 years from now. And that's going to outlive me. It's going to outlive everybody that's working for us right now and working along with us right now. But that's what we intend to do, because we want to make an impact on people to make sure they have a secure retirement and that they have all the income they need, sufficient income, and they pay as little as they're legally required to pay in taxes. That's our 2 things that we do that's different than anybody else.
It's such a strong mission. And you know what gets me excited, Tom, is the reason you're having this explosive growth is because you are reaching so many more people. Folks are needing this help. They are hungry for it. And what gets me really excited is this just shows that there's going to be a lot more lives that get to be changed for the better, right?
Exactly true. And just let me talk about how we grow. We are built on a track. Different businesses grow different ways. There's some people that leverage their growth and how would I say that? They get way out over their skis is one way to say it. They spend a lot of money with the hope that they're going to grow. What we do at Mosley Wealth Management is we're a little bit of the opposite. We've got 8 advisors that are writing in the field right now. now and that are working with people, that are building plans for people, that are putting together retirement blueprints for people. And there's a blueprint to the blueprint. So they're all going through the same format, regardless of who you work with, regardless of Encino or San Diego or Ontario or Arcadia or our main office here in Anaheim. You get the same blueprint because the input of that blueprint is where you are, what your accounts are, what your age is, when do you plan to retire, what are your plans for retirement, and how much do you need. That's how we build a blueprint. But what we do, Kristen, is we grow as our people get stretched.
Yes.
Okay. Now,
Mm-hmm.
what I mean by that is we're not out there leveraging, going in debt so that we be in trouble. Everything we've got is paid for. One guy asked me one time, he said, "You lease all your office furniture?" No, the only thing we lease is the office space.
Mm-hmm.
Everything moving into that new San Diego office is paid for. It's a done deal. Wipe your hands clean. It is owned by Mosley Wealth Management. When we get to a point where we have too many people who want to see us, that's what happened in January. We added another advisor. That's
Mm-hmm.
what happened. That's what's happening already in March, Kristen. We're adding
Yeah.
another advisor as a paraplanner down there to
Mm-hmm.
assist the other two writers that are down there. The other two, and I say writers, I mean, they're the ones that actually write the blueprint.
Mm-hmm.
Okay.
Mm-hmm.
They're the ones that actually sit down with you. They've been trained. They've been with us. The two in San Diego have been with me. The two advisors there, Travis has been with me 9 years.
Mm-hmm.
Charlie has been with me going on 6 years now. And so they're very experienced in what we do and how we do it. And they sit down with you. And to bring it into what we're going to talk about in today's show, they basically assess your risk in retirement. And they're all kinds of risk in retirement. And they sit down and they build a plan based on what you bring to the table to build that plan with. That's where we get the idea of the blueprint. We put together the blueprint that helps you know. And my why is the SCI. The reason we do business is for you to sit across that table from us and just you to sigh because you know all that angst of retirement and are we going to run out of money? Are we going to have enough income? Are we going to be able to enjoy our retirement? When you see that blueprint and you finally get a grasp that you are okay, that's why we do what we do.
Yes.
And we try to mitigate that risk, to take as much of that risk out as possible.
Yes, that sigh, that exhale of relief. And I know we're going to get into all the different risks here that can be addressed when you come in for the complimentary retirement blueprint. But if you're going, you know what? I want to have that sigh of relief. I want to be confident and see in writing, knowing that I'm going to have enough money to last me throughout the rest of my life and figure out strategies to help you pay less to the IRS. We encourage you to pick up the phone and schedule your complimentary retirement blueprint planning session. You can do so by calling 888-930-5609. You can't call and say, "Hey, send me one of those retirement blueprints." They're not things on the shelf. When you come in and sit down with one of the all-star advisors of Mosley Wealth Management, they're going to start with a blank sheet of paper and they are going to build it for you, customized to you from scratch. So again, we invite you to call 888-930-5609. Well, Tom, congratulations again on all that explosive growth. And really, you're growing because the demand exists. People are needing help. And I think one of the things that you do so well at Mosley Wealth Management is helping folks understand the transition and the change that comes with nearing, entering, and then being in retirement. And you teed this up beautifully. We're going to be talking a lot today about the problem of risk in retirement. And there's so many risks that retirees face. But I think, on just the base level, when we talk about just risk in general, a lot of people aren't even aware of how much risk they're currently taking with their investment. So I'd love to start off this conversation by you sharing a little bit about why that is and what you often see from a risk perspective when folks come in and meet with your team for the first time.
Well, I think it could easily be argued that if human beings are anything, Kristen, they're creatures of habit.
Hmm.
And in the accumulation phase, that's when you're building up toward retirement. And hopefully you started in your 20s, or you're in your 20s and you can start now, or your 30s, your 40s, whenever you started. Okay. You got into a habit of dropping your money into a 401k or an IRA, or just, investing in things. Maybe it was real estate, but you realized you were taking risk. And anybody who's been an investor over a period of time has lost money. Now, is that like a break across the waves there? I don't think it is, but the market, whether it's the real estate market, or if you're running your own business, or if you're just investing in your 401k or an IRA, the market goes up where you make money and the market goes down where you lose money. And the measure of how much you could lose and what kind of risk you're taking, that measure is your risk. That's what you're taking. When I'm 40 and I'm saving for retirement, when do I need that money? Probably at about 20 years, maybe
Hmm.
25, maybe a little bit less. So I can become a creature of habit that I can take pretty high risk. Now, last week we did a show on the 401ks, okay? And
Hmm.
we just really exposed everything to do with the 401ks that we could in an hour.
Yeah, especially
And
if you have those lost or old forgotten accounts behind, right? We had a great discussion about that.
I know, and we've had people call in and say, you know what, I'm glad the show was on because I've found 401k accounts and getting my stuff ready to come in to get my blueprint. So,
Hmm.
it's really important that you see that. But in that 401k, that is a high risk vehicle. It's something that you put your money in. It's really built for like 30-year-olds, 35-year-olds, and the habits you need to get into when you're 35 years old is put your money in the market, let it grow, and it goes up, it goes down. But overall, the market has always been pretty good to us. It's always gone up historically, given that four-letter word, TIME. But here's what we're talking about on this show, and we're going to talk about it in the final three segments. You've been a creature of habit, and that's been good for you because you've been able to handle the risk. Now, when you get to retirement, you get to a point where you're no longer putting money in. In fact, you're taking money out. And when we
Hmm.
come back from break, we're going to talk about how when you're taking money out, the risk is just compounded. It's exactly opposite of the way it is when you're accumulating up to that point. But you're a creature of habit, so you're used to taking higher levels of risk. The number one, you should be taking, or number two, even more importantly, you need to be taking. We're going to talk about risk on this show. Stay with us.
Yes, there's so many adjustments that need to be happening in your retirement plan, in your financial plan. Are you prepared to navigate through these risks successfully? We encourage you to reach out. You don't have to go it alone. The team of Mosley Wealth Management would love to be able to provide you with your very own complimentary retirement blueprint. 888-930-5609 is the number to call to schedule yours. We'll be back with more right after this.
Can you remember how different life was when you were 10 years old and 20 years old and 30 years old? You could be retired for 30 years or more as well. Imagine the different stages you will experience in a long retirement. One of the biggest concerns for most retirees is running out of money in retirement. If you've never planned for decades worth of income spending from your investments, savings, Social Security, and other resources, you don't want to get it wrong. Actively plan for a successful retirement by working together with a financial advisor whose practice designs these retirement income strategies every day in their firm. Tom Mosley of Mosley Wealth Management devises retirement income strategies for listeners just like you, and it's complimentary to get started. Call Tom Mosley of Mosley Wealth Management and ask for your own complimentary retirement income strategy. 888-930-5609. That's 888-930-5609.
Welcome back to Right on the Money with Tom Mosley. I'm your host, Kristen Oakley. We're so glad you're joining us today. If you're just tuning in, we are talking all about risk in retirement. And you did such a good job explaining earlier, Tom, how a lot of times as humans, we are creatures of habit. And most people don't realize that there are actually two phases when it comes to growing their wealth. There's the accumulation phase and then the distribution phase. And there's an important transition and change that needs to happen as folks are approaching retirement, then entering retirement, depending on what phase they might be in. And obviously, when you're younger, and I know you said hopefully people have started as early as possible. When you're younger, you can be really aggressive with your investments because you have time on your side. But then there's this shift that needs to happen, and you can no longer afford to ride that roller coaster with your investments, so to speak, because it's time to start withdrawing that money at some point. So, talk about that change and how you help folks navigate through that successfully.
Well, if you're out there listening, let me make you a 40-year-old right now, okay? You're 40, 45, somewhere between 40 and 49, okay? And you're accumulating your money in a 401k. Well, if the market goes down 50%, and it's done that twice since the year 2000, thereabout. From
Mm-hmm.
2000 to 2002, it was down about 47% over a period of time. I jokingly say that's when your 401k first became a 201k.
Right.
All right.
Yeah.
And then shortly thereafter in 2008, from about September of 2007 until March the 9th of 2009, the market went down 54%. So if I say it's been down around 50% twice since the year 2000, that's what I mean. If you're 40 to 49 years old and you're working and you're accumulating, that is a buying opportunity. Because what are you doing during that time? You're in that accumulation phase where you're pouring money into the 401k.
Yep.
I have people call Kristen sometimes when the market goes down, like in 2022, it was down 22%. And they actually call and say, I'm just starting off. Should I continue to add to my 401k because the market is down?
Mm-hmm.
Well, for goodness sakes, yes, because you're buying on sale.
Yes, I was going to
Understand.
say it's a great sale when the prices are down. That's when you want to buy more.
That's when you want to put as much into the 401k as possible. Now, let's make you now 70 years old and you're 3 years into retirement and you're drawing out. Instead of accumulating, you're distributing.
Mm-hmm.
You're dispersing the money that's in your lumber yard, your 401k, and you bought the Monte Carlo sales pitch of the big box firms, and you just left your money in the market, and you've listened to the big Dave on the radio who says you're going to make 8, 10, or 12% in the market, but you wake up in 2022 and you're down 22%, or you wake up in 2008 and you're down 54% because you listened to that Monte Carlo model and you're still just taking out enough money to live off of every single month.
Mm-hmm.
You're having to take out at a 50% downturn twice as many units or volume. You're having to take out twice as much equity out of your 401k to get the same amount of real dollars that you need to pay your mortgage, to pay for your car, to buy groceries, especially eggs, and to do those things right now. So you're having to take out twice as much. So a downturn is a buying opportunity in the accumulation phase when you're in your 40s. But when you get to 70, back to what we talked about in the first segment, you're a creature of habit. You're listening to that broker who's just got you in the Monte Carlo model. And I call it a hope strategy. Hope
Mm.
that your lumber yard still works out.
Right. And
You
just
know,
to interject that Monte Carlo model, a lot of people maybe aren't familiar with that term, but they've heard about the 4% rule, right? Which says you should just be able to withdraw 4% per year from your accounts for the rest of your life. And hopefully you won't outlive your money.
And then they've cut it down to 3.2% and said, now, if you
Mhm.
really want to be safe, which means if you've got $1 million that you've accumulated, you're really taking out, can you really take out and live off of just $32,000 a year? Because that's what 3.2% means. But if your $1 million in a market downturn goes to 500,000 and you still need the $32,000, then you're taking out 6.4%.
Right.
So
Yep.
it just works against you to do the same thing you've always done. In business, they say sometimes the people who got you here won't get you there.
Mhm.
Well, the philosophy that got you to retirement many times won't get you through retirement because and it's what we call in our industry, and I'm not trying to throw big terms out at you, but it's what we call sequence risk. And here's what it means basically. Right after you retire,
Mhm.
does the market have a big upswing or a big downturn? That could be what you're basing your financial future on if you're
Mhm.
using the Monte Carlo model.
And that's the problem, like, because we don't know what the market's gonna do right when you're planning to retire.
In the retirement master class, which is a 2.5 to 3 hour class that we teach, you can go to our website. We teach Social Security, taxes, and that retirement master class, which is an expanded version of retirement. The other two classes are 1 hour each. That retirement master class, sign up for one, come to one, because we're going to talk about in there when we talk about investments, sequence risk. And I will show you how $1 million using the Monte Carlo model, if you had retired in 1996, in 2018, you would have $1.6 million still in your account. Yeah, you started with 1 million, but you would
Mhm.
have grown to 1.6 and you would have taken out $1.3 million. Yes, that's exactly what happens in an expanding market if you hit it right. I'm not saying it doesn't work. I'm just saying that if you had waited to retire and done the Monte Carlo model in 1999 and you had retired, you would have run out of money. You say, why do you use 2018? That's 7 years ago. Because if you had hit it in the wrong sequence and there
Mhm.
had been a big downturn like there was from 2000 to 2002, you would have run out of money in your portfolio in 2018. And that's the biggest fear that people have in retirement. Not dying, they know they're going to die, but
Mhm.
running out of money before they die. And that's what sequence risk could do to you. You are totally throwing your financial future to the wind of the market to say, will it go up in the first few years after I retire, or will there be a big crash right after
Mhm.
I retire? That's what you're using if you're using the hope strategy that's called the Monte Carlo model.
Well, and this is why, Tom, so much of the problem with the way the financial services industry is set up as a whole, and I'm talking about the big corporate firms, is they do a really good job of the accumulation phase. They know how to help people grow their wealth, and we need that. That's an important aspect. That's when you're in the accumulation phase, that's what you need. The problem is they're not talking about the sequence of returns risk. They're saying, stay in the market, have that long term focus. Yes, that's true. And I should say, right, two things can be true at the same time. When you get to this phase of life, it's time to make this shift because of sequence of returns risk. It's something that you cannot control. Therefore, you need to have a plan in place so that no matter what the markets are doing, you're going to be okay.
Well, you've got to break your portfolio down. That's why we call it a retirement blueprint. And even if you're a soldier of the cross of the Monte Carlo model and you like what your broker's done for you, because hey, since 2008, the Dow Jones has gone from around 6,000 up to over 40,000. Okay.
Hmm.
So it's been very, very good to you, as the old saying goes. It's been very good for you out there. Okay. So you love it, but what happens if we have some kind of catastrophe? What happens if the monetary system of the world, the war system of the world, a lot of things are on the horizon? There are some people who are saying, we're already in World War III because there are conflicts going on all over the place. They didn't get to World War I and announce that it would start today or
Hmm.
start next week, or World War II. What happens there? And what if we have a tariff war? Or what if we have all of these things that don't bode well for the world's economic system? And you say, well, here we are again, creatures of habit.
Hmm.
You've been writing this thing for the last 17 years since 2008, and it's been good to you overall so far. You've had a few lumpy years, but it's been good to you. So you keep writing it. Now, what we do is we advocate a different plan. We advocate taking part of your lumberyard and building out completely and addressing completely your income for the rest of your life. It's why we do Social Security workshops. It's why we understand pensions. It's why we understand taxes. What do you need for income for the rest of your life? And we build out your paycheck plan with a portion of your lump sum of what you've just got in the market.
Yep.
And then the rest of it, Kristen, we leave in the market.
Yes.
Okay. And we leave it to a proper risk level. Okay. We leave it to your internal risk level. We match your portfolio to that risk level. The income side is your paycheck guaranteed for the rest of your life. The other side, the market side, is your playcheck. And that allows you to go do the things you want to do and enjoy the retirement you want to have, rather than just leaving it all in the market and hoping that it works out. Really important that you see the switch.
Yes. And when you can see that all in writing, there's such confidence and peace of mind that comes knowing that you can go ahead and spend the money to do the things you want to do during your physically able bodied years when you can do them, and be confident that you will not outlive your money. The reality is that the advisor that got you to this point may not be the right advisor to help continue into this distribution phase. We encourage you to get a second opinion, and you can't get a second opinion from the same person who gave you the first. But the team of Mosley Wealth Management would love to be able to provide that for you, along with that complimentary retirement blueprint. 888-930-5609 is the number to call to claim yours. We'll be back with more right after this.
In retirement, which accounts do you take from first to pay your monthly expenses? Your former employer plans like 401ks or 457s, your IRAs or Roth accounts, investment accounts or savings accounts? Do you use the growth from your mutual funds, ETFs, or bond funds first? Did you sell your business to create income, or do you have life insurance or annuity options? Should you start your Social Security benefits and let your investments grow, or should you take from your investments and let your Social Security grow? Are you unclear if you have a retirement income strategy at all? You have accumulated assets for retirement for years. Now you need an efficient strategy to make certain these assets work together and last as long as you need them to. Call Right on the Money with Tom Mosley and ask for your very own complimentary retirement income review. 888-930-5609. Make sure your assets will go the distance for you in retirement. Call Right on the Money and Tom Mosley and ask for your complimentary retirement income review. 888-930-5609. That's 888-930-5609.
Welcome back, Southern California. You're listening to Right on the Money with Tom Mosley. He is the founder and president of Mosley Wealth Management, and I'm your host, Kristen Oakley. We're so glad you're joining us this weekend. We are having a very informative, in-depth conversation all about risk with your retirement. This concept of risk, Tom, as you've so well set up for folks, the challenge is that there is a shift and there is a change that needs to happen between the accumulation phase of wealth planning for retirement, when you're growing your money and you're working and you're saving and you're putting that hard-earned money away, versus when you transition into the distribution phase and you begin to need to pull income from that lump sum. And you say this all the time, success in retirement is not about your lump sum, it's about your income.
Right, knowing that you've got that guaranteed income for life gives you the freedom, the peace, the ability, the sleep well at night pill that
Yep.
allows you to go spend what you need to spend in retirement. No, you're not gonna ruin your income.
Yes. And we wanted to address something that I had touched on in the last segment, and we were talking during the break time. You know my background and how the first 6 years that I was a part of this industry, I was working for one of the largest registered investment advisory companies in the nation. And what's fascinating is I look back on what we were educating and telling folks to do. It was to continue to use the market, continue to grow your money, set up that systematic withdrawal plan for yourself. The term sequence of returns risk was not discussed. And I think that right there highlights the difference between how much of our industry is just focused on the accumulation years and kind of continue to do what you have been doing. And I'm going to share a little bit about why that is too, versus what you focus on at Mosley Wealth Management, which is being true retirement planners. You're helping people navigate successfully the distribution phase, which comes with it a whole nother set of challenges, skill sets that need to be paid attention to. And when I think about the traditional model of a lot of these big corporate firms, the reason they want to tell people continue to keep the money in the market is because that's how they're paid. I mean, that's just
Right.
how it's set up, right?
Right. And yeah, I've got to go back to a story that I've told probably 50 times on the radio, and I tell it on TV every now and then. But I got into this because after 19 years of being in the ministry and being in charge of benevolence, I had people, and Kristen, I didn't know it was called the distribution phase that they were in,
Right?
but it was people that were in retirement. And I remember this big oil field worker that was standing in my office across the desk from me in Odessa, Texas, and he looked at me, and there was a big tear that came out of his eye onto his cheek, and he said, "I'm trying to decide whether to buy food or medicine for my wife because we can't afford both."
Mhm.
And the idea way back in 1995 when I was like, I feel like that country music song, I was country when country wasn't cool.
Right. Yep.
I was working with retirement planning when retirement planning wasn't cool, because in 1995 I told those guys that we're working with and they were trying to focus me into this industry. I said, I want to work with retirees to
Mhm.
make sure they don't run out of income the rest of their life. And they looked at me like I was crazy.
Right,
Well,
because they
what
were expecting you to say, "I wanna work with lawyers or doctors,"
doctors,
or whatever, right? Yeah.
people with money. But you know what's
Yep.
happened? Those big box firms, every commercial you see now by those big box firms that are still focusing on accumulation, they're still focusing on the Monte Carlo model. They're still hoping that their people don't run out of money because they hit the right sequence of risk or they hit the wrong sequence of risk. They're holding themselves out, and they've changed their shingle. They've
Mhm.
changed their sign to "We're a retirement fund. We're a retirement organization." And I
Mhm.
look at what they're doing when you who are out there, who many of you've been saying, well, I need to get on the schedule of somebody at Mosley Wealth Management because what they do is really different.
Mhm.
Okay.
Yep.
You do need to do that. And I said, how do I know people are saying that? Because they come into our office every single week. We've been listening for a year. We've been listening for 2 years. We've been watching the television show for a year. And you finally come in, you realize we're different. But it really bothers me when Chris and I open up the statements and I
Mhm.
begin to look at it, and these people are not matched up on their risk. Now, here's
Yes.
what I mean by that.
Yep.
We're talking about risk in today's show. There's two numbers, not, oh, well, you're balanced. Well,
Mm,
yeah, I hope I always maintain my balance, okay?
right.
Or you're moderate or
You're
you're growth.
aggressive, you're
Yeah.
conservative, right. It's such a cookie cutter approach too.
And what do those mean? My cookie cutter might be different than your cookie cutter, but
Mhm.
there are two numbers that we use. Now there's a big organization in the financial services field called Morningstar.
Mhm.
And what's really neat about Morningstar is they have no skin in the game when it comes to what you invest in.
Right, they're
They
independent third party reporting essentially, right?
I call them the consumer report of the financial industry.
Mhm.
But even the Consumer Report, we've heard stories before about how they get tainted a little bit by people who might advertise with their magazine or things like that. But the Morningstar people don't take any advertisement. They just do an analysis, and this is part of a retirement blueprint that we do for people when you come in, bring your stuff, and let us build a plan for you. We do a thorough analysis. We don't just listen to the motor outside the car. We open the hood. We
Mhm.
put the instruments on it. We let Morningstar tell us what is the risk level you're taking. And it gives us a number from 0 to 100. What risk level are you taking? You know what else it gives us? It gives us the performance
Mhm.
and it gives us what's called an alpha. And I'm not trying to wow you with terms, but if you've got a negative alpha, I saw one guy last week who had a minus 5.95% alpha. That
Wow.
basically meant that he was taking a risk level of a certain number, but he was getting about 6% less in a performance than he should have been getting each year.
So
6%.
translation, taking on more risk than he should have and not getting the gain for the amount of risk he was taking, correct?
That's exactly right. He had his foot on the accelerator at a
Mhm.
certain level, but the car just wasn't going as fast as he was pushing it. I've
Yeah.
driven old cars before, and
Yes.
when they get old and they get clogged up, they're just not running efficiently. And
Yep.
that's what we mean. And you say, well, I don't understand all of that. Right. That's why
Mhm.
most people aren't financial advisors. That's what we understand. But we take your portfolio and we get a risk number on your portfolio and we get an alpha number on your portfolio. We also are able to look at it through Morningstar, unbiased, and they tell us how much fees you're paying.
Mhm. Yep.
Because I have people every single month, people sit down with me and they say, well, I'm not paying anything for fees in my 401k, or this big box firm doesn't charge me any fees.
That's such a
How do
misconception. Yeah.
they build the buildings? How do they put on the commercials? They're taking fees. Morningstar report shows us all of that.
Yep.
But there's one other risk that you need to be aware of as well.
Okay.
And that one, and if I were looking at all of you who are out there, whether you're in the car, at home, wherever you are listening to this, I would point right at you. I'd point right at your chest and I'd say, inside you, right there, there's a risk number there too. That's your
Mm.
risk score.
Your
That
comfort level,
your
essentially,
comfort
right?
level.
Yeah.
Exactly. And I'll tell you what, I can show people numbers, and as I get higher and higher, I can see their discomfort. It's what percentage of the risk of the market do you want to take? Some of you are out there and you want to take a 33% as risky as the market. Some of you are good with maybe around 50, but it's not an estimate with some of the evaluations we give you. It will give us a risk score for you, which is your risk tolerance, to your term, Kristen, that you brought
Mhm.
up there. It's your tolerance. What are you able to tolerate? And I'll
Yep.
guarantee you one thing: your risk tolerance, what you have on the inside, needs to match your risk score in your portfolio. That's what's going to allow you to sleep at night. I know what my risk level is in my portfolio, and that equals me. Yeah.
Mhm.
What were you going to say, Kristen?
Well, I was just gonna say, it's interesting too because a lot of times we talk in percentages. How would you feel if you lost, as you use that example, 33%? Oh, okay. Well, maybe that doesn't feel so good, but maybe I'd be okay losing 20%. All right, but when you put a monetary amount to it, I think that wakes a lot of people up because when you actually say, "Are you comfortable losing $200,000 or $250,000?" Then it's all of a sudden it's like, "Wait a second, maybe not." maybe 20% is not going to work for me anymore.
Exactly. Here's what I say. I say, like, you've got a $1 million right now, but in the last downturn, if we went through a downturn like that last downturn, you would go down 38%. That's another thing that Morningstar report will tell us.
Right. It
Okay.
goes back in time and shows you how what you're invested in now, how it would have performed back then.
And so you ask people, you're okay with $1 million, but if that, because of the market, without you taking any money out of it, turned into $620,000, how would you feel?
Mhm.
Before they say anything, they sit in the chair and they start squirming. They start
Uh-huh.
moving
You can
back
read
and
the body
forth.
language, right? It says it all.
Right. And if here's what we're saying. If you are continuing to do the things that you did when you were 40, when you're 70, that's what you're facing.
Mhm.
And you may just bury your head in the sand and say, no, that's listen, you need to take all of that non-negotiable, that not all of that unknown. You need to have one of my advisors sit down with you and put together a retirement blueprint and solve all these numbers for you once for all.
And as part of that complimentary retirement blueprint, the team will run that Morningstar report for you. You're going to be able to see how much risk you're actually taking. You're going to be able to see how much you're actually paying in fees. And let me tell you, that wealth of information right there is worth your time to pick up the phone and call and receive this important information for you and your family. 888-930-5609 is the number to call to schedule your complimentary retirement blueprint. We'll be back with more right after this.
Which will you spend more money on in retirement, food or healthcare? Do you take your investments out of the stock market now that you're retired? How do you know if you've saved enough to stay retired? Will your Social Security check be reduced in the future? How do you produce income from your nest egg to fight costs like taxes and inflation? At Mosley Wealth Management, Tom Mosley and the team take the guessing out of retirement planning by devising a written plan that accounts for all of your concerns. The bigger question, are you going to be okay in retirement? Find out the answers to your retirement questions by calling Tom Mosley of Mosley Wealth Management, 888-930-5609. Income, investments, Social Security, Medicare, longevity, health care. We cover these solutions and all of those other questions on your mind to answer, are you going to be okay in retirement? Call Tom Mosley and Mosley Wealth Management for your own complimentary retirement review, 888-930-5609.
Welcome back, Southern California. You're listening to Right on the Money with Tom Mosley. I'm your host, Kristen Oakley, and a really informative and important conversation we are having today all about risk with your investments and how your risk tolerance and, even more importantly, your risk capacity often needs to change as you are entering and approaching and going into retirement. And Tom, it was interesting. We were talking during the break, and I had to share this funny story with our listeners. Often, I think the lack of awareness of how much risk someone is taking with their investments can go back multiple years to back maybe when they started their very first job. So I think of my sweet husband. I'm married to a public school teacher. And when we first got together, he had been teaching at that point for over a decade. And I was looking through his investments as we were starting to merge our lives together. And I said, babe, how did you pick this? Because it was completely not what he should have been invested in at all. And he said, well, I don't know. And this was back before everything was done online. So they had to fill everything out with, those forms and a pen. And he said, they didn't tell us anything. And so I just kind of glanced over at the guy next to me and saw what he put down on his paper. And I did the same thing. And I think a lot of folks can relate to that because there's not that education that's provided when folks have workplace retirement plans. It's easy to maybe even just get put into a target date fund, that kind of set it and forget it approach. And then you fast forward 40 years and all of a sudden it's time to retire and that's never been updated, never been looked at. And you have no idea what you're invested in. So I think that's a very common situation folks find themselves in.
No, I think sometimes it's like the old story when I used to be in the ministry and people say, well, I wanted a verse for the day. And I was thinking about doing something really, really bad. And I opened up the scripture and just blindly pointed to a verse for it to tell me what to do. And it was the verse in the Gospels where he was talking to Judas and he said, that which thou doest, doest quickly. Okay.
Mm.
It's like you really don't want to do something bad quickly. All right. So you can get the wrong advice by not having any advice, by just picking something. One guy told me one time when I was looking at his 401k and he had lost 32% with about $53,000 was what he had lost by being invested in a BlackRock fund. Now,
Mhm.
BlackRock's, it's a fund group that's out there in a lot of 401ks, but this was something just like Charlie, Kristen. He should never have been invested in that fund. It was totally different than what he should have been invested in. And I asked him, I said, why did you invest in that BlackRock fund? And he got all excited. It's like I had, it's like my little 4-year-old granddaughter, Marin, and she just gets excited about things. And he said, well, he said, I love Maui. And north of Lahaina there's this place called Black Rock where I like to go snorkeling. And it's just
Mhm.
it brings such joy to me. I saw that Black Rock fund and I thought, well, I need to be in it.
Right.
Well, and I told him, I said, for what you've lost, $53,000 this year in that BlackRock fund, you could go to Maui 4 or 5 times and
And
snorkel it.
snorkel the real Black Rock, right?
Exactly. So, and
Wow.
then not everybody uses that same kind of mentality. One of the things that we offer through all of our advisors is we offer 401k coaching. And we don't make any money off of that because we
Mhm.
can't make any money off your 401k. We don't invest that. But what we will do for you, if you are our client, we will take your 401k, we will take your risk tolerance score, and we
Mhm.
will match up your 401k investments to your risk tolerance. Now we'll talk to you about it and we'll say, are you 30? Let's put it pretty risky. Are you 50? Well, when are you going to retire? Maybe we need to start backing down that risk. We'll talk you through it, and then we will go through and analyze all of the options within your 401k. Again, we offer this for people who are clients, and we
Mhm.
will coach you on your 401k sometimes a decade before you ever retire, and then move that money over to us for to manage if you're still our client at that time. But we will do that just to help you get ready for retirement. But you need to have a clue as to why you're investing and what you're investing within that 401k.
Yes. And that 401k coaching that you provide, again, you don't make any money off of it. You do it because it's the right thing to do. And operating as a fiduciary, you have that legal and ethical obligation to always serve the client's best interests. Again, I'm so excited, Tom, for more folks to connect with you before they get to this transition stage where they need to adjust their risk, because you can help set them up for success years before to make sure they're on track, matching the right risk tolerance with the right season of life that they're in, with the right phase of their retirement that they're in. So that is such a huge gift that you offer. Again, if this is resonating with any of you, all you need to do is pick up the phone and call to schedule your time to come in and receive that complimentary retirement blueprint, 888-930-5609. Tom, one of the other things I want to ask you regarding risk, I know you work with a lot of married couples, and I've often found that spouses can have different risk tolerances from each other. I know that's true in our own household. So I'm curious, how do you help folks navigate that when you have one spouse who's maybe, able to handle more risk and is more comfortable to stomach that risk versus the other spouse who's not as comfortable? How do you help ensure that they're on the same page when you're building a financial plan for them?
Wow, it's almost like I have to go back to the ministry and do marriage counseling sometime. I
I'm
promise you
sure.
that's true. I think the most dramatic one was about 5 years ago. Client still works with us, great people, fantastic people. And he came in with a risk score of 22, which means he is very, very, very conservative.
Mhm.
And she came in with a risk score of 95. Okay.
Wow.
Just about
Wow.
as risky as you could be. And
Yeah.
they were retiring. They've since moved to Arizona. And I mean, it was really funny when we brought them in. So you know what we did? Instead of doing his and hers, we did theirs. Okay. So
Mhm.
we threw the risk analysis up on the big screen in our office, and we just let them walk, talk, and no, they didn't fight through it, but they had to talk it out to where they came with a score. So watch this. He was 22. She was 95. They came out with a risk score of 58 when they did it together. If
Okay.
you'll average 22 and 95, you're going to get it right at 58. It's so much told me that what we're doing in this evaluation is so true. I've had one person in 8 years of using that evaluating tool disagree with it. And a year after we put them at a higher risk than they thought they should be, the next year they came in, they said, there's times I can't sleep. Let's back it back down to what my
Mm,
risk score really is. So,
mhm,
so here, this couple, we ended up agreeing that we were going to shoot for an overall 58 for a risk score. Now, how did we get there? Now, this is in a deeper answer to your question.
mhm,
We can still be true to her and put her investments on the riskier side, okay, of
mhm.
58.
Right?
And we can be true to him by putting his investments on the less risky side of 58. So I call that a barbell type approach where there's nothing in the middle really, but we are true to her with her investments on the one side on the higher, and true to him with a lower investment risk score, being true to him on the other. And it's like a barbell. There's a lot of money down here, a lot of money up there, and not much money in the middle. That's one great way to do it. And I think that first year,
Mhm.
it was right. They were moving into a year where we didn't have that great of a year in the market, and he took less risk and actually had more money than she had. But in the subsequent years, when the market really takes off and flies at 15 to 20% gain, she's making more money than he is, but he's happy because he's not taking the risk. It all has to do with not what makes you happy, because making money makes everybody happy.
Oh,
Okay.
of course. Right. Yeah.
But being able to sleep at night and knowing your risk level and knowing you're where you should be.
Yes. And so much goes into determining that. And this is why, again, I love that when folks come in and receive this complimentary retirement blueprint from you, not only is your team going to build it from scratch specific to them, you're going to run all of these additional reports, things like the Morningstar report that we talked today. Why don't, as we close out today's show, I'd love for you just in depth to remind folks the incredible value, all the different pieces that they're going to be able to receive, and what information they're going to glean about their financial situation as a result of receiving their own complimentary retirement blueprint.
Well, we're just talking about the Morningstar report, and we're just talking about a Riskalyze report. It's pretty much all we've talked about. But what we do is we start at the base of a financial plan. We will run a Social Security optimization report, which will tell you, based on the other assets you have, when is the best time for you to take your Social Security. If there is a husband and wife, we build that plan and we run that Social Security, which will tell each of you when's the best time to turn on your Social Security. Do you have a pension? We'll do a pension analysis plan. We'll run an overall income plan for you. When it comes to investments, we will run the Morningstar. We will run the risk analysis of that. We will show you different options as to where you could invest and stay true to your risk tolerance. When it comes to taxes, we're going to run a tax analysis on all of your qualified money, on all of your capital gains. We're going to show you how much you should convert each year into a Roth so that you pay all the taxes and you never have to pay tax again once it gets into a Roth. We're going to do a healthcare analysis to see how you're going to carry and cover long-term care. I'm almost out of breath here, Kristen.
I know
And I'm
so much
and I'm
goes into it.
sure if I look back, we're going to have other things that we run when we do a comprehensive blueprint. And the neat thing about this, it's all complimentary. That means free if you don't understand the big word. We will sit down with you, build that, then you decide if you want to work with us as your financial advisor. Please pick up the phone and call us.
Yes, the team of Mosley Wealth Management would love to be able to help and serve you. Again, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how they can help and serve you, get your questions answered, and you will be able to walk away with a plan in your hands in the form of that complimentary retirement blueprint. 888-930-5609 is the number to call to claim yours. Hey, thanks so much for joining us this weekend. Be safe, be happy, be blessed, and we look forward to being back with you next time here on Right on the Money with Tom Mosley.
Investment advisory services offered by duly registered individuals through Mosley Wealth Management Incorporated. Mosley Wealth Management and Mosley Insurance and Financial Services are affiliated companies by common ownership license number OB61811. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refers to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength, claims paying ability of the issuing carrier. This content is intended for informational and educational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the needs of an individual situation. All hypothetical examples are provided for illustrative purposes only. They do not represent real-life scenarios. Mosley Insurance and Financial Services, nor its agents or representatives, may give tax or legal advice. Individuals should consult with a qualified professional for guidance before making any investment decisions. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Some of the information provided may be from one or more third parties, which we believe to be reliable sources, but accuracy and completeness cannot be guaranteed by Mosley Insurance and Financial Services.